2026 is going to wipe out specific type of property investor, not the beginners, not the ones who played it safe, the ones who made money in 2025 and think they have figured it out. And what makes it worse is the most of them won't know it's happening until it's already too late. Today I'm going to tell you 3 things that have shifted in this market. If you get these wrong, this year gets expensive. This market has changed. Let's be clear about where we are. On 12th of May 2026, Treasurer Jim Chalmers handed down the federal budget. And for property investors, this one is different from anything we've seen in decades. This isn't a budget that tweaked a threshold or adjusted a depreciation schedule. The government has gone directly after the 2 things Australian property investors have relied on for decades: negative gearing and capital gain tax discount. And here is the part you need to understand, that it's not a proposal anymore. It is now the law. The market started moving almost immediately. CBA cuts its 2026 price growth forecast from 5% down to 3%. Now that downgrade was not caused by the budget alone. CBA pointed to higher mortgage rates as the main factor, with these tax reforms also weighing on prices. But that adjustment happened before a single vote was cast in Parliament. That tells you how seriously this was being taken. And now there's no more if, there's only how does this affect me. Here are the 3 changes you need to understand. You may lose the ability to offset losses against your salary. This is the big one. For decades, negative gearing allowed investors to offset rental losses directly against their personal income, salary, or wages. It reduced what they paid in tax every year the property ran at a loss. Under the new law, that is gone for established residential properties, but only if you bought after a specific point in time. So who does it apply to? If you sign the contract on your established investment property before 7:30 p.m. on budget night, 12th of May 2026, you are grandfathered. Your negative gearing stays in place for as long as you hold that property. Nothing changes for you on that asset. And there is no cap on how many grandfathered properties you can have. If you held 5 properties before the budget night, all 5 are protected. If you buy an established residential property after that point, the rules are completely different. From July 1, 2027, you will no longer be able to use the rental losses from an affected established property to reduce your salary, wages, or other non-residential income. Those losses get quarantined and carry forward. But they do not have to wait until you sell. They can be used against your residential property income later years, including rental profits and relevant capital gains. And they are generally pooled across your residential property positions, not locked to the property that created the loss. Shares, commercial property, and other asset classes are not affected by this change. Neither is your own home. Here is a real example of what that looks like. Say your investment property brings in $30,000 a year in rent, but it costs $38,000 to hold once you count interest and other expenses. Under the old rules, that $8,000 shortfall reduces your taxable income. Under new rules, for an established property bought after the cutoff, that $8,000 no longer reduces your salary or other non-residential income. It gets parked and carry forward to use against residential property income instead. That changes the cash flow equation completely. The annual tax saving that made a negatively geared property livable to hold is no longer there. The investors who feel this hardest are the ones with high borrowing, low rental yields, and a strategy that dependent on the annual tax saving to stay afloat. If that is your position right now, this change lands directly on you. Your exit just got more expensive. This one is about what happens when you eventually sell. The 50% capital gain tax discount has been part of this country's tax system since 1999. Hold an asset for more than 12 months, sell it, and you pay tax on half of the gain. The benefit is now legislated to end. From 1 July 2027, eligible gains move from the 50% discount to cost-based indexation, which adjusts your purchase price for inflation. And for covered gains, an extra calculation may apply to make sure the effective tax rate on the gains is at least 30% before tax offsets. To be clear, this is not a separate 30% tax added on top of your normal tax. It is a minimum floor. This isn't just a property rule either. It applies to capital gain assets held by individuals, trusts, and partnerships. Companies are taxed differently and aren't affected by this particular change. And to be clear, your family home is untouched. The main residence exemption stays exactly as it is. Now, here's the part that most investors are not fully across. If you already hold an eligible asset and sell it after 1 July 2027, the rules effectively split your gain into two parts. The gain up to 30th of June 2027 stays under the old 50% CGT discount rule. The gain from 1 July 2027 onwards falls under the new indexation and minimum tax rules. To work out that split, the default method uses the asset's market value just before 1 July 2027, or you may be able to choose an apportionment method prescribed by the minister, and the ATO is expected to provide tools to help apply it. So the 1 July 2027 value still matters, but a formal valuation is not automatically required for every investor. Either way, start thinking about that date now. For eligible new residential dwellings specifically, investors will be able to choose between the existing 50% discount and the new indexation model when they sell. The flexibility is not available for established properties bought after the budget night. The bottom line here is simple. If you're modeling a property purchase right now, do not use the old CGT numbers. Run the exit under the new rules. If the deal does not work without the old concession, you now have the answer. Your borrowing capacity has already shrunk. This is the change most investors are not talking about, and it is the most immediate one because it is already happening. Here's something most people do not realize about negative gearing. Banks do not just see it as a tax refund at the end of the year. They actually factor that projected tax benefit into their serviceability calculations upfront. It gets treated as a form of income that reduces your effective holding cost, that improves how much you can borrow. With negative gearing now gone for established property bought after the budget night, the banks did not wait for the parliament. Macquarie moved first, formally changing its investor serviceability policy on 18th of May, just 6 days after the budget. Removing negative gearing add-backs for established property purchase contracted after 12th of May. NAB followed, then ANZ, CBA, Westpac, Suncorp, Great Southern Bank. Within weeks, virtually every major lender has rewritten its calculator. What does that actually mean in numbers? Industry estimates suggested a typical investor in the 37% tax bracket with one negatively geared established property could see their borrowing capacity drop by around 10 to 15% on a 1 million loan that can be over 100,000 in borrowing power gone. Investors holding multiple negative gearing properties could see their total borrowing ceiling shrunk by even more. And if you had a pre-approval issued before the budget night, do not assume it still stands. Several lenders have confirmed that applications not yet unconditionally approved are being reassessed under the new rules. The tax benefit that was factored into your assessment may no longer be applied. Go back to your broker. Get the numbers rechecked under the new rules before you commit to anything. Why new builds may just become the smarter investments. This is the one part of the new law where the rules could move in your favor, provided you understand the limits. For eligible new residential dwellings, negative gearing stays. Investor can still deduct losses against their salary, and when an eligible investors eventually sell, they can choose between the existing 50% CGT discount and the new indexation system, whichever works out better. But the word eligible matters. The property has to meet the legal definition of new residential dwelling and genuinely add to the housing supply. Not everything marketed as a new build will automatically qualify, So check before you commit. That said, for properties that do qualify, this is a deliberate and meaningful tax advantage over established stock that did not exist to the degree before 12th of May. The government intent is clear. Redirect investors' demand away from the established stock towards the new construction. More builds, more supply, more housing. For an investor, the opportunity looks real, but a tax concession does not make a bad property a good one. And this is the part we stress with our own clients. New builds in oversupplied areas with weak rental demands or poor construction fundamental will still underperform. Investors who chase the tax position without doing the underlying investment analysis are the ones who end up holding something that does not work. The tax treatment is the potential add. It is not the whole strategy. What to do about it? Here's what this comes down to. This is now law. The market and the banks have already adjusted. The only question is whether you have. If you hold established property bought before the budget night, you're protected on those assets. Do not let that noise push you into a decision you do not intend to make. If you're planning to buy an established property this year, run the numbers under the new rules, not the old ones. Model the deal without the negative gearing offset, model the exit with the new CGT treatment. If it still works, it is a genuine investment. If it's only worked because of the tax concession, you now have your answer. If you're looking at a new build, the tax advantage is real, but only for properties that qualify as an eligible new residential dwelling. And location, rental demand, build quality, and the price still determine whether the property actually performs. And if you have not spoken to your accountant or broker since the budget night, that conversation is overdue. Your borrowing capacity has probably already changed. Your tax position is about to look very different. The 2026 budget is the most significant shift in the property tax settings in a generation. The investors who came out of this well are not necessarily the ones with the most capital or the longest track record. They are the ones who understood what was legislated and started adjusting early. If you want to understand exactly how these changes affect your specific property portfolio, what is grandfathered, what is not, what your borrowing capacity looks like, how to model your exit, this is exactly what we do. Book a complimentary strategy call with our team. The link is in the description. And if this video helped you understand what is actually happening, subscribe. Cover what is actually happening in the market, not just the headlines. See you in the next one.